Federal Reserve policymakers are expected to announce in about an hour or so that the U.S. economic recovery is underway. Our next guest says the recession did end back in June or July. He says we are in the first quarter of recovery, but it's a very weak one by historical standards. Ethan Harris is the chief U.S. economist at Bank of America-Merrill Lynch and joins us now from his firm's camera. Ethan, great to see you.
Thank you.
So there's a lot going on here with regard to the Fed. Obviously, the unprecedented year we've had in the Fed's role in all of that. So we were talking in the break, advise our audience the best way to approach the Fed today and to understand what their goal is.
I think people need to understand that the Fed's in no rush here to exit from these extraordinary policies. You know, just ending the recession isn't enough. They want to see sustained recovery in the economy that brings down the unemployment rate. And so it's too early for the Fed to be announcing some grand new strategy to wind down the policies. They need to keep them in place.
The last accompanying statement read, economic activity is leveling out. Since then, when Fed Chief Bernanke was speaking at the Brookings Institute, he said very famously, now the recession is likely over. So what will that statement say today about the economy?
Yeah, I mean, the Fed must be gaining confidence in the recovery, just like the economics profession as a whole. I mean, the data in the last few months has been quite convincing. It really does look like we're in the beginnings of the recovery.
And it will reference activity?
Yeah, so they can point to a lot of factors. We've seen manufacturing surveys pick up. We've seen a little bit of life in the housing market. The only area of the economy that's still in a recession, or a serious part of the economy in recession, is the labor market, and that will eventually come out of the recession. So there are a lot of hopeful signs to point to here.
Do you expect to hear anything at all about exit strategy? You said that the theme here is that the Fed's going to be very slow with its plans. Is there any way to give any sort of hint as to what they're thinking?
I think they're still going to give a statement that just says, you know, we're continuing our programs. And they may hint at some minor technical adjustments to the way they manage bank balance sheets, but those are technical adjustments. The big exit, you know, is still a long way off. The Fed needs to prepare for the big exit and set up the contracts and the agreements with counterparties. They want to do that way in advance, but they don't want to be signaling the exit until they're really confident that the economy is well on a recovery path.
Are you talking about this idea of doing reverse repos to sop up some liquidity if need be?
Right. So a lot of the talk in the marketplace right now about the Fed making a big announcement comes from the fact that they've been going around trying to figure out how many of these reverse repos can we do. I mean, the Fed is going to have to sop up a lot of liquidity, about $1 trillion liquidity in the banking system. That could be disruptive to the markets that they do counterparty arrangements with. They're now trying to feel their way forward and figure out, you know, how much can we do in this market or that market. That doesn't mean they're going to start doing it. They're just kind of doing their homework. The big final exam doesn't come until next year.
How do you think the Fed should unwind its major programs?
Well, I think that they want to, first slow down the buying of these assets. So they've already announced that with the Treasury buying. I think you will hear a similar announcement about their mortgage buying. They want to do it in a gradual fashion and make sure they're not shocking the markets. I mean, the last thing you want to do is cause this very fragile housing recovery to reverse. Then as they go forward, they can start to slowly draw reserves out of the system. I think by 2011, they'll probably be ready to raise interest rates. I realize that sounds like a very long way off, but people forget that it took more than 30 months in each of the last two economic recoveries for the Fed to start hiking interest rates. So the Fed does want to see real improvement on a sustained basis before they hike interest rates.
Ethan, what can the Fed do now with its treasuries and mortgages that it's purchased? What kind of instruments can it use to continue to keep the economy buoyant?
Well, I mean, if the economy were to start to slip a bit here, they could extend these programs and expand them and continue to offer this targeted support to the capital markets. But I think that the recovery will continue without new extraordinary measures. And I think at that point, the best thing they can do is simply be very cautious about selling these assets. That could be a shock to the markets. I think they're going to do that. I think they're going to hold these assets for a while, wait until the markets are strong and robust and can handle the Fed basically taking the markets off life support. once the markets are ready to come off life support, then they can think about announcing a plan for selling the assets. But that's going to be a while.
Will the Fed address deflation concerns with regard to the slack we've been talking about in the economy and companies' lack of pricing power?
Yeah, I mean, they have to be a little careful around. They don't want to sound doom and gloom about deflation. On the other hand, they're trying to dispel this argument that inflation's about to pop up any second. I frankly don't understand that argument. You know, inflation doesn't come out of nowhere. It requires a recovery in the economy, it requires a recovery in credit markets, and then eventually you get an inflation problem. But the Fed, I think, would agree that, you know, at least the majority of the FOMC would agree inflation is a distant concern. And in fact, if anything, there's a greater risk of deflation than inflation over the next 2 years.
So then as we wrap up our chat here, Ethan, what kind of recovery are you anticipating?
Well, people talk about U's and V's and L's and W's. All of these are a little bit misleading. If this was a normal business cycle after a collapse in the economy, we'd be seeing 5, 6, 7% growth in the first year. That's a real V, where you come flying out of the recession. Instead, what we're expecting is something like a 3.5% recovery. That's just a little above the weaker recoveries we've had historically. I think of that as a U, frankly, based on my reading of history. It sounds like a V because people are so negative on the economy coming into this period, but it's actually a pretty slow recovery.
Ethan Harris calling for a U-shaped recovery. Chief U.S. Economist at Bank of America-Merrill Lynch, many thanks.